Welcome, viewers. Shares versus property. Where you should invest and what is your investment. Always confusion comes into people's mind. Should I go to property or should I go to shares? Which one to go for? And which one has outperformed over the last several years and which is likely to perform over the next years. So in this video, I want to show you shares versus property and how to pick up your investment strategies and investment portfolio. Now, why this question matters? Of course, this question matters because you don't want to lose your money end of the day and you want to get maximum out of your investments. And both are very popular investments, shares and property. Over the last so many years, we have heard from a lot of investors, whether they invest into shares or property, one get richer or the other. This is what you need to know. Each is your wealth creation tool, right? End of the day, long-term financial planning is required for both of them. And this is going to attract your investment maximization in future. And this is why this question is very important. Now, property. What is property? Property, residential property, commercial property, any source of property is your property. Vacant land is your property as well. Shares. What is shares? The ownership into companies. This will give you dividend over the period of time and of course the capital growth over the longer terms. So both is a wealth building opportunities. This is going to help you. One will give you rental income plus capital gain. Other will give you dividend plus growth over the years. Now think about how property works. So the way property works is you leverage through your mortgages. Example, let's say you own a house. That's happy you. So this is your house. Now, end of the day, if you have an investment of worth $1 million and you want to borrow money over it, depending on how much equity you have, let's say you have a loan of 500,000 on this. Now, remaining 500 is your equity, which you can build over and you can borrow against your rental investment. So leverage is the main thing here. This leverage option is not available into shares. If you go to the bank and tell them, look, I want to invest into a shares, more likely they're going to say, no, we don't lend for investment into shares. But for property, this can be done. So this becomes easy in a way that you can use other people money to invest into property, which is OPM, other people money. You might have heard that name before. So this will give you rental income, long-term capital gain, appreciation, potential tax benefit depending on the rules, because it could be capital gain in nature, tax exempt or taxable. Different rules will apply. This is how property will build your wealth. Now shares works in a different way, because shares we have many things such as your ETFs are there, your managed funds are there, passive income portfolio strategies are come in many form or shape. But overall the rule remains the same, where you got dividend income and capital gain over the period of time. So diversification of these funds become a key. Now remember one thing, the entry to this is very low. Anyone can come in. Even with $100, you can come in. You don't have to pay the rates, insurance, and things like that. You just can simply own a small units only worth $100, and gradually you can build that portfolio. So if you're just starting up, you're a student or something new, you can start up very small, just $100, $200, $300, build up your investment portfolio, and this will really help you in long term and teach you good wealth management skills. In general, shares, this is not historical thing. I don't know will this happen in future or not. Over the last so many years, S&P 500 has given approximately 7 to 8% return on income. So this is annual return. So compound that by 10 years. So what we're talking about, every 10 years, your income, what you have invested has been doubled. So if you invested $1,000, it becomes 200,000 becomes 200,000. So that has happened. Now property has also shown a strong long-term growth and which is a leverage driven. Remember, it's not your money to start with. You never had any money to put in. You just borrowed from bank and put into there. So that has also, so both have done very well. However, certain circumstances, certain regions, certain companies, certain countries' investments work in a different way. But over the last so many years, both have provided a good investment income. Risk comparison. Now, from the risk point of view, you can say property is less risky in a way that you don't have any problems such as companies going bankrupt, you losing all your money, all your investments, plus company don't get into liquidation. Companies get into liquidation, but property don't get into liquidation and things like that. So from the risk point of view, property wins here, whereas the shares don't. However, if you have diversified your share market risk through various economy and through various industries and through various ETFs, then you can reduce those chances. However, property also comes with such risks such as maintenance issues, flooding, natural disaster. These kind of risks are also available, but these risks can be eliminated through insurance, picking up the right property, doing regular inspections, regular maintenance. You can mitigate those risks. Again, these risks are different to different investors. So my risk appetite, your risk appetite, someone else's risk appetite, all of us have a different appetite of a risk. So you need to see which one you are okay with, and then you go and through there. Liquidity, here in liquidity, shares simply win because you don't need to know who the buyer is, who the seller is. Transactions of millions of dollars can be done within a day without even knowing who the person is who's buying it. Facilitation, you don't need the agent, you don't need to put board outside your house, you don't need to do marketing and things like that. Things can be sold when the price is right, just sell it within 2-3 days, you get the money. So liquidity, shares always win. Property do not win in liquidity, as it will take you months to get your money back, and when you need that money, you're not going to get it. If the property market is down, which is always happen every 3 to 5 years, it runs into cycle, a boom, bust, recovery, different time of the year, it can have a different outcome of your sale price. Leverage, of course, leverage, simply the property wins because you can use only 200,000 deposit and balance of money can be refinanced to buy the house, and gains apply to the entire value, not only the deposit that you have put in. So this is from the leverage point of view, certainly this one's cost. Property will have more costs such as rates, insurance, maintenance, management fee, interest. However, brokerage fee and the fund management fee, that's only 2 costs for that. However, that cost can chew up your funds as well. Imagine you got $1 million invested there and you're paying 1% management cost each year. So you're talking about $10,000 worth of expense each year, regardless of how much money they generate for you. Like certain years they generate money, but certain years your 1 million might become 950, you might lose $50,000, but you still have to pay management fee of that. So this could be quite problematic for some people. However, in property, you will always get rental income that's coming to you from the tenants. One more thing is the tax factors. Shares, different tax rules apply for different investments. Property will get into different rules such as bright line tax, the year of purchase, the year of sale, plus shares will get into dividend tax, FIF tax, those sort of tax will come into that. Over the years, simplifications have been put into both, each government trying to simplify, but they don't understand. Every time they come to simplify, actually they make it more complex. However, this is how the tax system works. Nothing can be done because tax is always used to change the behavior of society. So this has always been, this will always be, that's not going to go away. Which build wealth faster? Ooh, that's a big one. I think there is no right or wrong answer. My advice to you would be both build the wealth faster. I would start with one and gradually move to the other. So whether you're starting with a property, start with the property, build your portfolio and then move to shares and investment, or you start with shares and then gradually build your portfolio and then move to property. My advice is always align your risk and look at both simultaneously. So ideal portfolio could be, you might want to do look at this diagram, you might want to do 30, 30, 30, 10, such as 30 property, 30 shares, 30 managed funds, and balance 10% cash. That could be your ideal portfolio. Now, final takeaways: both shares and property can build significant wealth. Property wins on the leverage, as you will have your own money plus other people's money to purchase something. Shares win on liquidity and compounding. Strong portfolio will blend both of these assets. That would be the key takeaway. Need further advice? Contact us if you need any advice in terms of your tax planning, investment planning. We can help you achieve your financial goals. Thank you.